Whatever you do, do not open your tax-free savings account with a bank. Hi friends, there's a million things you could be doing in this moment, and yet here you are, spending time with me. Thank you. I value the asset of your attention, and my commitment is to cherish that attention. My goal is to offer you value that will hopefully improve your personal finances and your life in general. The age group I have in mind as I create content are those between the ages of 25 to 35 primarily. But of course, the concepts we'll discuss in this channel will be applicable to most. Disclaimer, I am not a financial advisor, and nothing I say in this video constitutes as financial advice. I will simply share my thoughts, my opinions, and journey for educational purposes. But first, who am I? I don't know about you guys, but before I give someone on YouTube 2 minutes of my attention, I like knowing a little bit about who they are. And so, I am Lunga, a 30-year-old South African, currently teaching English as a second language in China. I was born and raised in the dusty streets of Mdantsane in the Eastern Cape. Growing up, I experienced my fair share of relative poverty, but I've also been fortunate enough to taste the middle-class lifestyle. This ebb and flow in financial circumstances has encouraged me to be curious about personal finances. Hence, the first focus of this channel, personal finance. But I also majored in psychology in my undergrad and sociology in my postgrad. So, I have a passion for topics connected to human behavior and society more broadly. Topics like trauma, personal growth, social mobility. Basically, topics about life. To cater to this second focus of the channel, I will be inviting guests onto the channel to share their journeys with us. I'm excited for the journey ahead. With that said, let's get into today's topic. What is the tax-free savings account? Why is it important? Where is the best place to open or move your tax-free savings account? These are some of the questions we will discuss in today's video. Now, a conversation about tax-free savings account becomes interesting only when you have taken care of a few personal finance basics, including budgeting, paying off or managing high interest debt, building an emergency fund. Budgeting is the foundation of personal finance. It is your financial map of life. As the old saying goes, if you do not tell your money where to go, you will wonder where it went. We can do a separate video on setting up a budget if you like. Just let me know in the comment section. But I like to keep it simple. I just do it on my notes app on my phone. And because I already have a structure in place, it only takes a few minutes to do each month. Number 2, paying off or managing high interest debt is important. These include personal loans, credit cards, etc. The reason attending to high interest debt is often more important than investing is best explained through an example. Imagine the following scenario. It's the 10th of March 2024, and Buhle has a lump sum of 2,500 rands. In scenario 1, Buhle has a personal loan with an outstanding balance of 2,500 over a 12-month period at an interest rate of 29.25%. If Buhle pays off this loan over the 12-month period, she will end up paying a total interest of 731 rands 25 cents. However, Buhle decides not to pay off her loan, but rather decides to invest her 2,500 rands over the same time period at an interest rate of 15%, resulting in a return of 375 rands. Thus, the difference between scenario 1, which is 731 rands 25 cents, and scenario 2, which is 375 rands, is an amount of 356 rands 25 cents. In other words, Buhle would have saved 356 rands 25 cents if she had simply paid off her high interest debt as opposed to investing. Yavakala mos guys. Number 3, building up an emergency fund allows you to have a buffer between emergencies and your medium to long-term savings and investments. It also protects you against needing to take out loans to handle life's rainy days. It's recommended to have savings to cover your monthly expenses for 3 to 6 months, even a year if possible. Your emergency savings should be accessible. In other words, if you have an emergency today, you should be able to access your funds today. Now, let's talk about a tax-free savings account. What is it? The tax-free savings account was launched by National Treasury in partnership with the financial services sector in 2015. It was meant to encourage a savings culture in South Africa, particularly for retirement. I want to repeat that for emphasis. It is for retirement. The greatest benefit of a tax-free savings account is in its ability to save on taxes. Let's discuss some rules governing the tax-free savings account. Firstly, contribution limits. You can contribute a maximum of 36,000 rands per annum and a lifetime contribution of 500,000. Any amounts above these limits will be taxed at a rate of 40%. This is an example from the SARS website where a taxpayer invested 40,000 rands into their tax-free savings account as opposed to 36,000 rands, which is the annual limit. Therefore, there will be a penalty of 40% on the excess amount above 36,000 rands, which is on the 4,000 rands. Just to go through it together, 40,000 rands minus 36,000 rands, which is the annual limit, will give us 4,000 rands. And what will then happen is that 40% of the 4,000 rands will be charged as tax, which will be an amount of 1,600 rands. So whatever you do, please make sure that you stay within the annual limits of 36,000 rands and the lifetime limit of 500,000 rands. Anything over and above those amounts will be taxed at a rate of 40,000 rand. Number 2, you cannot invest in individual companies or risky asset options like cryptocurrency, etc. The government have put these regulations in place as a safeguard against loss of your hard-earned cash. These are the following asset classes you may invest in a tax-free savings account. Put simply, in your tax-free savings account, you can invest cash, bonds, unit trusts, and my all-time favorite, ETFs. If you do not know what these fancy names mean, calm down, drink some water, and relax. I've got you. If you need me to make a separate video on cash, bonds, unit trusts, and ETFs, just let me know in the comments section. But put simply, cash, are things like fixed deposit that earn an interest. Bonds are basically borrowing the government money and they pay you back with interest. Unit trusts are single products actively invested in many different companies for diversification. In other words, there's an active manager of that account that regularly buys and sells shares to ensure profitability. ETFs are also single products invested in many different companies. However, they are passively managed and generally cheaper than unit trusts. Okay, so why is a tax-free savings account important? It is important because you save on the following taxes. Number one, interest tax. Number two, capital gains tax. Number three, dividends withholding tax. In order to appreciate not paying tax on products within your tax-free savings account, it is important to understand a little about taxes. Let's start with local income tax. If you own bonds or have cash in the bank, then the interest earned is subject to tax at your marginal tax rate, which is between 18 to 45%. However, as South Africans, we have an annual exclusion of 23,800 for those under the age of 65 and 34,500 for those above the age of 65. So for example, as a South African with savings in the bank of 4,500, oh god damn.
Listen properly.
As a South African with savings in the bank of 450,000 rands, receiving 5% interest per annum, which would equal 22,500 rands, you still wouldn't trigger local interest tax because of the annual exclusion. To cut straight to the point, having a tax-free savings account with a bank is the worst way to use this instrument because we already have access to the annual exclusion, and it would take the average South African many years of saving to trigger interest tax. Number two, capital gains tax. Capital gains tax was introduced on the 1st of October 2001. It is a tax on the difference between what you buy an asset for versus what you sell it for, assuming that you make a profit. For example, if I had bought Naspers shares in March 2023 for 10,000 rands and I decided to sell them in March 2024 for 15,000 rands, I would have locked in a profit of 5,000 rands. That 5,000 rand would be subject to capital gains tax of 40%. However, as South Africans, we have a 40,000 rands capital gains tax exclusion per year, which means you are charged tax on capital gains only after 40,000 rands has been subtracted. Number three, dividends withholding tax. When a company makes a profit, they have two options. Number one, they can reinvest the profit back into the company. Or number two, they can pay profits out to shareholders, aka you and me. When a company pays out to shareholders, this is called dividends. Therefore, dividends withholding tax is a tax on that payout. Simply put, at a rate of 20% for local dividends. Therefore, a tax-free savings account is important because you save on interest capital gains, and dividends withholding tax. In other words, your profits within a tax-free savings account are yours to keep, tax-free. Finally, for the most important question, where is the best place to open or move your tax-free savings account? We already know that banks are the worst place to open a tax-free savings account. Companies like Sanlam, Old Mutual, as well as Allen Gray are no better because of the associated fees for managing the investment products inside your tax-free savings account. Quite simply, investing in your tax-free savings account is something you can do for yourself through a broker platform like Easy Equities. I cannot tell you what to invest in, but I can share my personal strategy. It's a very simple one that's influenced by one of my favorite personal finance YouTubers, Pieter. Disclaimer: the ETFs I am about to share are not completely tax-free, as they include offshore companies. Offshore is just a fancy way of saying companies from abroad. Tax-free saving account rules do not apply beyond the borders of South Africa. However, due to the historical exponential growth of the offshore market compared with South Africa, I am confident that you'll be better off with these ETFs. The caveat is that you must keep them in your tax-free savings account for many years to reap the benefits of growth and the wonder of compound interest. Here goes. I invest 80% of my contribution limit into the 10x Total World Rand-denominated ETF, which basically tracks the world's economy. It includes companies from the developed markets as well as the emerging markets. Number 2, I then invest 20% into the Signia Global Property ETF, which basically tracks the global property market. If you had opened your tax-free savings account with a bank or other financial services provider and would like to move it, you can. Just make sure you do not withdraw your funds from one account and deposit them into another. Rather, contact your provider of your tax-free savings account and ask them to move or to transfer your account to your intended provider. For example, you can instruct Old Mutual to move your tax-free savings account to Easy Equities. You can also instruct Easy Equities to get into contact with Old Mutual to facilitate the transfer of your tax-free savings account. Final thoughts. March presents a unique opportunity for all South Africans. It's the start of a new tax year, which means a reset in terms of tax-free savings contribution limits. As of the 1st of March, 2024, all South Africans had a contribution limit of 36,000 rands for the year. The question is, what are you going to do about it? If you found value in this video, do me a favor and hit the subscribe button and share this video with a friend. Till next time, bye.